When people compare stocks and crypto, the biggest difference to understand is what you actually own. With stocks, you own a piece of a real business. That business has customers, revenue, expenses, leadership, and measurable performance. If the company grows and becomes more profitable over time, your ownership becomes more valuable. Stocks are tied directly to economic productivity. Crypto is different because most cryptocurrencies do not represent ownership in a company. Instead, they represent participation in a digital network or protocol. Their value depends on adoption, usage, trust in the technology, and market demand rather than traditional profits. Stocks also benefit from an extremely long and well-documented history. We have over a century of data showing that, despite crashes, recessions, wars, and economic crises, the stock market has trended upward over long periods of time. This long-term upward trend is driven by innovation, population growth, and businesses finding new ways to generate value. Crypto does not have this kind of history yet. Bitcoin is just over a decade old, and many popular cryptocurrencies are even younger. That makes crypto exciting, but it also makes it far more uncertain because we don't know how these assets will perform over multiple generations. Volatility is another major separation point between stocks and crypto. Stock prices can move up and down, sometimes sharply, but crypto price swings are often extreme. It is common to see cryptocurrencies rise or fall by double-digit percentages in a single day. This level of volatility can create life-changing gains, but it can also wipe out large portions of an investor's portfolio very quickly. Stocks tend to reward patience, while crypto often rewards timing. For many people, managing the emotional stress of crypto volatility is harder than managing the slower movements of stocks. Risk management looks very different between these two asset classes. When you invest in diversified stock funds, you are spreading your money across hundreds or even thousands of companies. Some will fail, some will stagnate, and others will grow, but the overall system continues to function. In crypto, many projects fail completely. Some lose relevance, some are poorly designed, and others turn out to be outright scams. This means crypto investors must be extremely selective and must accept that total loss is a real possibility for individual assets. Regulation also plays a huge role in the stock versus crypto debate. Stocks operate in a heavily regulated environment. Public companies must release financial statements, follow accounting standards, and comply with strict rules designed to protect investors. This doesn't eliminate risk, but it does provide transparency and legal oversight. Crypto operates in a much less regulated space. While regulation is increasing, the rules are still evolving and vary widely across countries. This lack of clear regulation allows rapid innovation, but it also increases the risk of fraud, hacks, and market manipulation. Accessibility is one area where crypto has a clear advantage. Anyone with an internet connection can buy crypto in minutes, often with no minimum investment. There are no traditional gatekeepers, and participation is global. Stocks are also more accessible than ever, especially with modern brokerage apps, but crypto removes almost all barriers to entry. This accessibility has helped crypto spread quickly, especially among younger investors. However, easy access can also encourage impulsive decisions and speculation without proper research. Income generation is another important distinction. Stocks can produce income through dividends, which provide cash flow regardless of whether the stock price is rising or falling. Many investors build portfolios specifically designed to generate consistent income over time. Crypto typically does not provide income in the traditional sense. While staking and yield strategies exist, they come with added layers of risk, including platform failures and technical vulnerabilities. Dividend income from stocks is generally more predictable and easier to plan around. When it comes to long-term wealth building, stocks have a proven track record. Consistent investing, reinvesting dividends, and allowing compound growth to work over decades has helped millions of people build financial security. Crypto has produced massive gains for early adopters, but those gains have been unevenly distributed and often depend on timing rather than consistency. Whether crypto can reliably create long-term wealth for the average investor remains an open question. Psychology plays a massive role in the success or failure of investors in both markets. Stock investing encourages patience and long-term thinking. Crypto often amplifies emotions like fear, greed, and fear of missing out. Social media hype, viral price predictions, and constant price updates can push investors to make decisions based on emotion rather than strategy. Many people lose money in crypto not because the technology fails, but because they buy during hype and sell during panic. Time commitment is another factor many people underestimate. Stock investing can be largely automated. You can set up recurring investments, ignore daily market noise, and let time do the heavy lifting. Crypto often requires more attention. News about regulation, security breaches, or changes in technology can dramatically affect prices. Successful crypto investors usually spend significant time researching and staying informed, which may not suit everyone. Taxes also differ significantly between stocks and crypto. Stocks benefit from long-term capital gains treatment when held for over a year, and retirement accounts can defer or eliminate taxes entirely. Crypto transactions are often taxable events, even when you trade one crypto for another. This can create complex tax situations that reduce overall returns if not managed properly. Many investors underestimate the tax impact of frequent crypto trading. Stocks tend to work best for investors who prioritize stability, long-term growth, and financial planning. They are well suited for retirement accounts, consistent contributions, and building wealth slowly but reliably. Crypto tends to attract investors who are comfortable with uncertainty, high risk, and rapid change. It appeals to those interested in new technology and alternative financial systems, but it demands discipline and strong risk management. One of the most common mistakes investors make is treating crypto as a guaranteed shortcut to wealth or dismissing stocks as outdated or boring. Both views are flawed. Stocks and crypto serve different purposes and carry different risk profiles. Successful investors focus less on hype and more on building strategies they can stick with through market cycles. For many people, the most practical approach is not choosing one over the other, but understanding how they can coexist in a portfolio. Stocks can form a stable foundation, while crypto can represent a smaller, speculative portion with high upside and high risk. The key is allocation, diversification, and knowing exactly why each asset is included. At the end of the day, stocks offer ownership, regulation, historical data, income potential, and lower volatility. Crypto offers innovation, accessibility, decentralization, and the possibility of outsized returns with significantly higher risk. Neither asset is inherently better. The right choice depends on goals, time horizon, risk tolerance, and the ability to stay disciplined when markets become emotional.